Let's move on and talk about a conversation that we had with Dr. Fereidun Fesharaki, who is the founder and chairman, as you know, of FGE. And this is an exclusive conversation that he now had with him about how OPEC and its allies are balancing what is clearly a dynamic situation as far as demand and supply is concerned. About the fact that oil prices are currently where they are right now, Brent crude at near $80 per barrel. And we also got some valuable insights on the pace and the adoption of ESG and the impact that that can have. Listen in for more.
Last year, we were worried about demand. What would COVID do to demand? Nobody knew, and the OPEC was struggling to try to balance the supply to fit the demand. This year, things are different. We have a reasonably good idea of what's happening to the demand. Demand is recovering very well everywhere in the world, including India, and there are no real lockdowns left anymore. So it's all a matter of supply, supply, supply. So it is how OPEC Plus is matching supply to demand. And it's a trial and error issue. So they try to match it to get to the desired price. What is the desired price? They don't tell us, but we believe the desired price this year is between $70 to $80 a barrel. Long term, maybe $60, $65 a barrel. But it is the matching of the two things together, the supply and demand, which has become now very critical. And OPEC Plus meets 3rd of October. If they cannot balance this properly, the prices will go to $90 or even higher.
We have always seen in the past, at least the trend has been that it takes OPEC Plus a couple of meetings to get the formula and everybody on board as far as the production goes. So when you say that if they can't agree and crude prices could hit even $90 a barrel, what kind of a window are we talking about?
The window is very short. They meet October 3, which is kind of within a week from now. And they need to come and propose to add 500,000 barrels per day or 1 million barrels per day, either at once or in 2 stages or 3 stages, to give the market the signal that additional volume is coming. The problem is that a lot of the green movement has been one of the factors that is behind the increase in the oil price. Because the green movement says, don't produce oil, oil is bad. Okay, I don't produce oil, but the demand is there. The demand goes up. So this green movement itself has been one of the big reasons that oil prices and gas prices have gone up.
I want to talk to you a little more about the gas prices. Look at the way they have gone up. Back in India, the Indian natural gas prices, when it's up for revision, is also expected to be revised, and we could see a big spike. What is your outlook as far as the natural gas prices go? That really impacts industry and production.
Well, in natural gas prices, you can buy it in 3 different ways, internationally imported. One is you can buy oil indexed. And many Indian companies have bought oil indexed LNG, and so they are shielded from all these higher prices. They don't worry. The price of oil goes up, they pay more. The price of oil goes down, they pay less. But they pay something like about $6 to $8 a million BTU. While in the spot price today is $30 a barrel, equivalent to $180 oil. So oil has OPEC. OPEC keeps things in a balance. But gas has no OPEC. So spot prices on gas are a problem. And Indian governments in the past have encouraged Indian importers. Don't buy oil indexed. Oil index is bad. Buy on the spot basis. And this has been not a very good advice, because they assume that the spot prices are lower and more stable, which is fundamentally a wrong assumption. So many people kept themselves exposed, and now they have to go and pay the high prices.
When we look at the energy basket, now everything is of course connected at the end of it. You know, when we talk about crude, electricity production, coal shortage. So if I were to ask you to see all of this together, including the disruption that we're seeing in China, whether it is cutting off power supplies, which is then having an impact on the gas prices. If I were to ask you how you're seeing this disruption in China and the impact in the medium to long term it's going to have. We're seeing the short-term impact, the knee-jerk reaction we are all seeing.
Well, the reason for the power supply problems in China are, or the problems at petrol stations in the UK, are more country-specific. I don't think we can put them in the same basket. But again, it comes as part of the green movement. So the Chinese government, as part of their pledge to cut back carbon, they have been shutting down a lot of the coal mines. Importing coal, but shutting down coal mines. Shutting down of the coal mines because of the geographic distribution has led to the shortage of electricity. At the same time, they do not want to import LNG at the equivalent of $200 a barrel. So they have been holding back because the electricity prices are regulated. Like in India, if you pay more for gas, you are not able to pass it on to the consumer so easily, unless you're replacing oil. So this basically miscalculation has ended up in this problem. But a lot of it, again, is that the issue of trying to cut carbon back has stopped coal production and reduced oil production and reduced gas production. And all of these things are going to lead to major imbalances in the market because of, I think, excessive green movement success in the balancing the carbon versus economics of the society.
Yes, we're of course seeing clarion calls also from within China to import more coal. But a very pertinent point that you raised there, that like in China, in India too, the pass-through is always very, very difficult, whether it is from the government to consumer or whether it is also from industry to consumers. And this brings me to my next point. What we are seeing now may force some countries to try and look more inwards. Now, typically when gas prices go up, crude prices go up, you see more investments. But the times that we are in, it's all about ESG, it's about renewable. There is call to move away from thermal power, move away from crude. So do you think this time round, when prices go up, we will also see investments go up?
Well, this is a very good question. You know, in the international, in the US and Europe, the ESG movement meant that the activist shareholders are have a hammer in their hand and banging on the head of the companies. You cannot invest here, you cannot invest there, you cannot do this. So if they don't invest, then the production goes down. And production goes down, the prices go up. The question really is this, is that we are not ready for the world of ESG. Maybe 10 years from now, I believe that sometimes around early 2030s, gasoline and diesel demand globally will peak and start falling. That's the time to move for ESG. I think the movement of ESG at the balance of the ESG with the needs of the society in terms of the energy sector are out of balance. They are not really moving in the same direction. We are pushing too far in one area and not pushing enough in the other area. And is it going to change? So far, it doesn't look like it. So far, it seems that we are going to be faced with a period of high prices instigated by the green movement.
I started this interview by saying that earlier this year you predicted $80 for Brent, for crude by the third quarter of this year, and it's exactly as you predicted. You've already told me that if we cannot fix this crisis, you'll be looking at $90 a barrel. We've got an OPEC Plus meeting also come up. What is your outlook for gas and crude prices in case OPEC Plus is able to arrive at a solution?
I think for crude prices, I'm hoping the prices can go down to about $70 a barrel by the end of the year. If they put in some more volume in there and change the sentiments in the market, it can go down. In fact, as you and I are speaking, the prices have dropped from $80 to $77, I believe. But it is, I think, some movement on the OPEC side can make the prices go down a little bit lower. On the gas issue, the problem is different. The biggest problem in the gas side is in Europe. And in Europe, we have a carbon tax. I mean, in Asia, in India, we don't have a carbon tax. The carbon tax is very high, $75 a ton. And that carbon tax is forcing coal to gas switching. Anybody who has any coal, pushing to gas. So that means that for the next 3-4 years, gas prices will be high in Europe, and the gas prices in Europe are closely linked to Asian spot prices called JKM, Japan-Korea market. And so I think for the next 3-4 years, gas prices will be higher than the oil index prices. I don't think at these levels of $30 a million BTU, maybe $15, $17, but it's still quite significant numbers, putting great pressure on the industry because heavily driven by the carbon pricing in the Europe. So EU carbon prices changing the global gas price. And the message of that is that buying oil indexed is much safer.
Gas prices are going to be...
Buying oil indexed is much safer than buying on the spot basis.
So if gas prices are going to be indexed above crude, so gas prices are going to be indexed above crude, we're looking at some serious concerns for inflation.
Yes, because if you buy based on the basis of crude, then the crude prices go up and down, it will go up and down, but you are linked to a percentage. That would be safer because OPEC cannot allow the market to get out of hand. But gas, spot price of gas has no regulator, the world. And now when one factor comes, such as the European carbon price, it pushes it up globally. And there is no force to bring it into balance. So if I am an Indian buyer, I would focus on buying oil indexed. Oil indexation has very reasonable prices. 10%, 11% slopes are not available in the market. And Indian buyers can buy it. But many of them have stayed away from it and try to follow the advice that the government had given earlier to focus on the short-term spot prices, which has been now very, very high and out of balance.
Yeah. At the same time, we're looking at what's happening in bonds, the currency market, all of that also impacts India and, being such a large importer of oil. How can India seize this moment with what's happening in China, with what's happening in Europe? Are investors in the oil and gas space now looking more favorably at India? One of the largest national companies is going to come up for sale sometime next year. I'm of course talking about BPCL. We're all waiting for the Reliance Industries and Saudi Aramco deal to also close.
Yes, but these deals are fundamentally in nature different. One is a private company selling 20% to Aramco. Aramco is a very huge exporter of crude and wants a home for the refinery. So Reliance is a perfect match for that. Meanwhile, Reliance is pushing heavily into petrochemical sector. And this is what the Saudis would like. BPCL does not have any, but has some upstream assets around the world, including the gas in Mozambique. But the company coming up for sale, I think the appetite would be more limited. India is not a great market for foreign investment. And historically, every time India has offered an upstream sector, only Indian companies bid. This has happened so many times, NELP 1, NELP 2, NELP 3, and every time the government said, this is going to be a flood of foreigners coming in. Not one. It's always the same. So I'm not sure whether there is that much appetite for buying a state-owned company in India. The domestic market still, in terms of retail, is attractive, but on the upstream side, is not that attractive.